Welcome to the Commercial Real Estate Academy podcast, the podcast dedicated to simplifying the commercial real estate industry for the masses. Each week, we sit down with industry experts to dissect the many facets of commercial real estate and extract valuable lessons you can apply to your business. Whether you're a new or seasoned business owner or investor, the Commercial Real Estate Academy podcast will be your go-to resource for all your commercial real estate needs. Now, here are your hosts, Raphael Collazo and Jeff Walston.
Welcome to the Commercial Real Estate Academy podcast. I'm your host, Raphael Collazo, here with my co-host, Jeff Walston. How's it going, my friend?
It's going great. Just ready to finish out the week strong, and holidays are coming up, and end of the year, that's a big one, huge one coming up. So how about yourself? What's going on with you?
Yeah, your wedding day, huh?
Big day.
Right around the new year. So that's great. And we all know that the day after Halloween is pretty much Christmas, right? You're starting to celebrate for getting ready for Christmas. At least that's in Puerto Rico. That's how it was. It was like people just are doing Christmas for 2 months, and then the next month it's like still Christmas. And I'm already ready to go for that. But speaking of celebration, I mean, we had a phenomenal guest today. His name was Yonah Weiss. He's a business director at Madison SPECS, and he really is a teacher at heart. And we learned a ton about a very valuable and unique strategy called cost segregation. It's a way to be able to save a significant amount of money and obviously amplify your returns as a result over a period of you owning a piece of commercial property. So throughout the podcast, we learned about what cost segregation was and why it's beneficial for both real estate professionals and passive investors, because we have plenty of people listening that are that fall into those two categories. So you'll definitely want to listen to what he has to say as far as that's concerned. And then we also dove into different scenarios of how cost segregation can apply in different scenarios. So, if you're building properties from the ground up, if you're doing expansions, and various other things like that. And then finally, we walked through some case studies to kind of drive the point home as to how exactly this strategy works and why it would be beneficial for you to consider if your properties, at least if he even said if it's above $500,000, it's pretty much a no-brainer to do this type of or employ this type of strategy. So I think you guys will gain a ton of value from listening to this podcast episode, as I think it's one of the most effective strategies for amplifying returns in commercial real estate. What do you think about that, Jeff?
I know I learned a lot, particularly me, on this particular topic, and going to be able to utilize these strategies and help me out in further investing and stuff. So I know that you guys will gain tons of value from this podcast, and if you're on YouTube listening. So I can't wait for you guys to listen up. So
definitely, man. No, and I can't reiterate enough how eloquent and how much of a teacher Yonah is. He really does break down a very complex subject and makes it very digestible for people, because again, we're not an expert in tax strategies. So having someone like Yonah to come in and explain something like as complicated as this type of strategy in a way that people can understand is really beneficial. So definitely tune in, stay tuned, and let's go ahead and dive right into the podcast. So welcome, Yonah. Excited to see you this morning.
I'm really excited to be here. I mean, you guys are awesome. Love this, the fact that you guys are doing this podcast, and happy to just share whatever we can do, help out other people.
Oh,
yeah.
Sure.
Thanks for coming on.
Oh yeah. And for those of you guys who don't know, I believe I met Yonah through, we had him on the Commercial Real Estate 101 meetup. And then I've been involved in several of his LinkedIn CRE challenges, which are phenomenal. If you ever have an opportunity to be a part of it, I would highly encourage you to do so. It's great to be able to build a network within the commercial real estate business. And really, Yonah is the go-to expert for cost segregation, which I'm really excited to dive into, because it is such a powerful strategy for being able to amplify your returns over a period of time. So welcome, Yonah.
Happy to be here.
Awesome. So when we first start off, what we usually like to do is we like to learn a little bit more about the person who's across the table from us. So if you don't mind, just kind of sharing some information about who you are and tell us a little bit about yourself.
Sure. I guess the most important things you should know about me is I'm a really nice guy, got a long beard. Now married, beautiful family, 6 kids. I was a teacher for many years, but got into real estate about 6 years ago when I was just looking for something else. We were kind of looking for some more income, some more stability to kind of build wealth. And as my family was getting bigger, realized needed to be a little more responsible with that. And in real estate was kind of like a no-brainer. And for many reasons, we can get into that a little bit later. And I've talked about this many times, but soon I learned that, I love to teach. I mean, I was like, okay, should I start a new profession, do something else? But like, really, at the end of the day, I love teaching. I love helping people. I started a nonprofit many years ago, traveled the world really fundraising and doing a lot of stuff. But my passion is really in helping people and in teaching. So I tried to find a niche, whatever you want to call it, within real estate that allowed me to do that. And that's kind of where I wound up in cost segregation. Along the way, I did some investing. I'm currently doing investing. I'm actually working on, multifamily deals myself currently. But it's all been part of the journey of just networking, meeting the right people, and continuing to learn and grow. So that's a nutshell about me. I don't know what else we can dig into, but feel free to dig in.
No, for sure. And I think it showcases when the way you talk and explain stuff to people, you could tell that you kind of have an educator's mindset, an educator's background, because you really do take the time to sit down and explain things very clearly and carefully so that people do understand this process. And as we'll dive into throughout this podcast, it can get somewhat convoluted. And so having someone like you that's a lot more, that's really comes from a giving mindset is, I mean, again, it's evidenced by the way that you project yourself to the world. So.
No, I appreciate that. Yeah, again, it's just about being yourself, figuring out what your superpower is or what it is that you're best at, and then trying to utilize that to live and to make a living. And so I feel extremely blessed that I've been able to find this kind of niche where I'm able to really have fun all day. I mean, just do what I love, connect people, and contribute to the community in a very powerful way.
Yeah. And I just want to say teacher is like, to me, one of the hardest jobs out there with having kids and going through the whole COVID issue and being their own teacher. It's like respect went from like already high. Now it's just, it's way up there for teachers. So commend you for that. But speaking about teaching and how that kind of led you into the niche of cost segregation, are you focused more on like the commercial real estate side of it instead of like residential? What got you interested more in commercial?
Well, it really was more than anything, just the circumstance, the opportunity that came up. I did actually I did a lot of things at the very beginning of my kind of journey within the real estate world. And so I started off as a commercial mortgage broker and kind of learned the ropes from a friend of mine who had been a mortgage broker for many years and learned everything about commercial real estate. Then I found another friend and learned the residential side of things in the actual brokering, being a realtor for a little while, and really wanted to just get my feet wet and everything. When I came across this company, Madison Commercial Real Estate Services, the company I work for, Madison SPECS, which is a branch of that company, it was more focused on that, although I'm still involved with residential in a lot of ways, especially of late with the short-term rental market, which is, even though it's residential, it also has a commercial feel to it. So it's more about transaction, more about business than it is, a lot of times residential properties, even though they can be transacted through investors, but it's a lot of times just people buying their own homes. And so that's really not where my focus is, more about the business of real estate.
Okay.
Yeah. So producing income from the property is really what you're focused on. And as we'll touch on in cost, why that would be a benefit, a cost segregation when you're buying a property that you're producing income for. So
100%.
So can you explain, we've said the term cost segregation several times. There may be some people listening that don't have experience with that. So could you kind of explain what exactly cost segregation is and maybe when it's worth it to pursue it as a strategy?
Sure. I'm sure there's a lot of people that don't know what this term means and maybe have never even heard it before, or maybe have heard it but still don't understand it. So essentially it's a form of depreciation. And so the name is really weird, but in the end of the day, what we're looking at is the depreciation deduction on a property, which is not intrinsic to the value of the property. It's really kind of a borrowed term from the IRS, a tax deduction. So let's simplify it. When you buy a property, the IRS allows you, that's an income producing property, a rental or a business property. So anything besides for your personal residence. The IRS gives you a tax deduction called depreciation. And it's based on the principle that things go down in value as time goes on, as the name presumes, right? Depreciation means going down in value, but really your house or your property or your business, whatever it is not going down in value. It's actually increasing in value, probably appreciating. But this tax definition of depreciation is a little confusing sometimes. So it's a good thing. You want depreciation. It's a tax deduction based on that fact. So simply put, you can write off literally the entire value of your purchase price, aside for the land. Land does not depreciate, so there's always a little bit carved out to land, but the rest of the building is depreciated over a 39-year for commercial properties or 27.5-year period for residential multifamily is 27.5. And those are kind of arbitrary numbers, but that's what depreciation is. Cost segregation is really just an advanced form of that, meaning the IRS has delineated that really it's not just the building that depreciates on a 27.5-year schedule. There's all these individual components inside the property and outside the property that have their own value to them. And you can take the value of those individual components as depreciation write-offs at their relative lifespans. And so really it used to be called component depreciation, which makes a lot more sense than cost segregation. But if you kind of just reverse engineer that term, it's like we're segregating, we're breaking out the purchase price, the cost, right, from the original value and then into these individual components.
Definitely. No, for sure. And it is a very powerful strategy for that. You can take that depreciation sooner in the life of you owning the property, thus being able to have more tax benefits early on within the life of your ownership.
Exactly.
And one of the confusing parts too is, like you said, it's the improvements. It's not necessarily the land value. So some people, if you buy $1 million property, you may not be able to take the depreciation on that $1 million because a portion of that is associated to the land. And so, I've had that question sometimes where it's like, oh, like I didn't necessarily know that, but
yeah, absolutely.
So that's awesome.
For sure. So there's all these individual components, all these different things. And so the job of a cost segregation company it's really an engineering approach, even though it's accounting. And so when we think about depreciation, we think about taxes or a tax deduction. And a lot of people, their brains turn off whenever you start talking about taxes, right? I'm sure you've experienced this. I've experienced this. It's like, oh, taxes. I have an accountant or whatever. But for real estate, if you're in real estate, especially commercial real estate, you have to understand some of the basics because it's so fundamental to your return. I mean, you're talking about the difference of, you could be talking about a 10 or 20 or 30% difference of returns, just based on understanding the taxes and the power of tools and strategies like cost segregation. So as you mentioned, Raphael, the cost segregation is so beneficial because it increases your deductions early on, which allows you to keep the cash. And a lot of people, I mean, if you're in the corporate world or you've had any sort of paying job, W-2, you know that your taxes are just deducted from your paycheck, right? But with real estate, it really doesn't work that way. If you make money on your property, at the end of the year, you kind of have to report how much net income came in. And then how many deductions were there? So you have all these expenses. You have mortgage expense. You maybe have all these other business expenses. And then you include depreciation as another expense, but it's not a real expense. That's the difference between depreciation and all those other expenses. Everything else, mortgage, you had to pay the bank, right? Pest control, you had to pay that guy, right? All those expenses, but depreciation, it's listed as an expense, meaning a deduction. It's reducing your taxable income, but you actually keep the cash, which means you just don't pay the IRS because you have more deductions sometimes than income. And so that's the power of cost segregation.
100%. And the fact you can take it early on in the life cycle is very beneficial too, because we all know that $1 today is worth more than $1 in 10 years. So, from a inflation standpoint, it's better to take your deductions early on. And then taking that money that you can keep and invest it other places now amplifies your returns over time as well. So there's various benefits as to why this could be a very valuable strategy.
100%. Yeah, I actually had a CPA recently did a video on a webinar and literally just broke down the numbers and showed how literally the difference between using cost segregation versus not using cost segregation was literally the difference between, I think it was like an 18%, return versus like a 44% return. And so when you're talking about your return on investment, which if you're a smart investor is going to try to reinvest those funds to keep building on that wealth, this is like one of the most powerful tools out there.
Yeah, speaking of that, on the tax benefit side of things, if you're a passive investor, what are the benefits and taxes for the passive investor?
For passive investors, the main benefit is, if you put money into a syndication or something like that, the returns that you're getting are, if cost segregation is being utilized on that property, the returns are going to be basically tax-free during the life of ownership. Okay, so that's the main benefit. If you happen to be a real estate professional, which means you're a broker or you're involved, you own your own properties maybe, and maybe you're managing or anything like that, or in construction, you actually get a double benefit or more benefit than anyone else, because normally depreciation deduction can only be used against your rental income. So rental income from real estate is considered by the IRS passive income. So if you make, let's say $50,000 of income from all your investments, from all your rental income, but then you get this cost segregation and you actually get like $200,000 of this extra depreciation, right? It's huge. That's much more than your actual income. Unfortunately, unless you're a real estate professional, like if you're just a passive investor, high earning W-2, whatever it is, you're limited to use that depreciation only against any rental income you have. And you may have investments from several properties. It can be used against all of them altogether, but otherwise it's still limited to that.
Sure. And how does that work if let's say you have, $50,000 coming in for the year and you take a depreciation of $200,000? Does it move forward? Does it move over to the next year, or how does that work?
Yeah, it carries forward. Any extra deductions that you have that you don't use are, like I said, considered a passive loss. And that loss, unless you're a real estate professional, just carries over and you can use next year or any future year. And it's kind of like an imaginary bank account that just kind of stays with you and you can use for your to lower your taxes in future years. There's a lot of kind of factors, even if you are a passive investor, but you have some of these factors. Like I said, if you have other investments, then that may actually change your benefit. If you are like I said, a real estate professional, that's huge. If you have unused passive losses from the past, right, from other properties, maybe that will also affect your income. So there's a lot of different ways that you can benefit from the cost segregation, even as a passive investor.
Sure, yeah, and touching on the real estate professional side, because we have a lot of people who listen to this podcast who are commercial real estate agents, developers, anyone with a commercial construction, that sort of thing. So we have people who are real estate professionals operating within the space. And like you mentioned before, there are some additional benefits if you are a real estate professional. I was just wondering if you could kind of elaborate a little bit on that.
Yeah, the main benefit as a real estate professional, like I said, is that the passive losses are no longer limited just to your rental income. And so it can be used to offset your ordinary income. So let's paint the picture. Let's say you're a broker, right? You're making, maybe, I don't know, let's say $500,000 in commissions on the year. Are you doing well? Maybe even seven figures. You have to, I'm telling you, if you are a real estate broker, you must also invest. You should. Okay. I'm telling you, not that you're required to, but I'm telling you, it's a good idea to also invest in rental properties, because that depreciation benefit can be used to, like I said, not only offset the rental income that you have, but your active income as well, which no other profession really has that benefit. So that's really the main thing.
Definitely. Yeah. So in the situation where, you make $50,000 in rental income and you have a $200,000 depreciation, and let's say you also make let's say you make $300,000 or $150,000 as a real estate professional for the year, you can apply that $200,000 depreciation to deduction to the rental income, and then take that other $150,000 and now apply it to your active income, which would be your commission-based income. Therefore, you could pretty much not pay taxes for that entire year if you had enough deductions.
Exactly. Really, that's the benefit. That's the point. Use this as much as you can to lower your taxable liability, keep reinvesting, keep doing it for as long as you can.
That's phenomenal.
Yeah, it is. So let's just paint a picture here. So we got a building, and we say we had it for 6 months and we're doing the cost segregation, but how are future improvements accounted for if you're doing and performing a cost segregation study? Can you explain a little bit that?
Excellent question. So as I mentioned in the beginning, when you buy a property, the IRS gives you that depreciation deduction, your basis that you can now deduct. That kind of pool of deductions is based on your purchase price and solely on that. If you do a refinance or get it appraised at a higher value, it doesn't matter. Unfortunately, that will not change the amount of depreciation that you can take. However, when you do improvements, when you add more money into the property, you actually get to add that to your tax basis, which means you can now depreciate all of those costs as well. So let me paint a picture in terms of that. Let's say you bought a property for, I don't know, $1 million, right? It depends what kind of property it is, depending on where you live in the country, right? In California, it's a single family, right? In Arkansas, it might be like a 32 unit building, right? Whatever it is, right? You got your $1 million property. That's now establishes your tax basis, the amount that you can depreciate. You're always going to subtract a little bit for land, like I said, maybe 10, 20%. And then the remaining amount you're going to split up over a 27.5-year period. Then year 2 or even the first year, you decide, I want to go ahead and upgrade these 32 units or this single family, whatever. And I'm going to put in an extra $300,000 into, totally redoing these property, right? Putting in a new parking lot, new roof, new everything. Those costs are going to be segregated, right? Those values are now going to be put on a depreciation schedule. And I want to break down for you what that actually looks like in terms of what those, we're talking just kind of general, this cost segregation, but what are those individual assets and how can you actually depreciate them at a faster rate? So the building, the structure, that's the only thing that depreciates on a 27.5-year period. Our engineers are going to identify what that is: the roof, the doors, windows, walls, floor, right? Anything that's structural, plumbing, main electric, all that stuff, infrastructure also is included in that. There's, could be drywall, foundational stuff, anything like that. However, anything that's interior, that's non-structural, and that could be anything from furniture to appliances, fixtures, even lighting, cabinets, countertops, carpeting or vinyl flooring, wall coverings, all kinds of stuff, window treatments. Literally, there's so many different things. When you look at a property, I mean, even the fish tank behind you, that's 5-year property. All that stuff that I just mentioned depreciates on a 5-year schedule. So the job of the engineer is to identify all those individual components, add that up, give a value to all of those, and then break that down. So we're taking the purchase price and we have to kind of reverse engineer the property of including all those individual components and the values that they have, adding back up to that purchase price. So when you build a new construction, it's really easy because you know exactly every line item. I know I spent, $25,000 on drywall and, $20,000 on flooring and et cetera. So all those costs can be very easily allocated to those respective depreciation lives. But when you buy a property and everything's included in it, you don't know. That's the job of the cost segregation. Outside the property, you have land improvements. That stuff, landscaping, pavement, curbing, right? Anything, if you have fencing or signage, anything outside the building has value to it and it depreciates on a 15-year schedule. So it's different than the land. It's on top of the land and that all has value, right? Pavement, asphalt costs money. That's the job of the engineer, identifying how much of that exists and then applying a value to that. All that stuff can be accelerated to a faster, like I said, 5-year or 15-year depreciation schedule. And now with the new tax law, you may have been a part of one of your questions, but is this thing called 100% bonus depreciation, which actually allows you to take all of that stuff and take it in the first year as a tax write-off. So all up front loading it all the way to the beginning, instead of waiting 5 or 15 years to spread those tax deductions out, which is still beneficial, but front loading it all to the first year can be, game changing.
Oh, for sure. Go ahead, Jeff.
I was just going to say, does that, say you were saying that's like a 300,000, just little addition or add-on improvement. Does that start, say, once you're finished, or can you do that once each item's complete? It's like, say you're at the end of the tax year and you're still not complete with said full remodel. Can you still take parts of that and include that in the depreciation, or do you have to be finished with that section?
As long as it's placed in service. So the IRS deems something placed in service. So you may have, let's say that 32 unit and, this year you're renovating 10 of those units. Next year, you're going to do another 10. In each phase, you can depreciate those construction costs that were placed in service, meaning it's been completed, and now you can do that for that tax year. And it is judged on a year-by-year basis. So that's an excellent question.
Yeah, that's definitely. And how would they know? I guess my other question is, as you're doing these renovations, is an engineer involved in that process to where they say, okay, well, now you guys have done these renovations, the kitchen's going to do this kitchen's, that, like, all the different components, they're holding your hand as far as that process is concerned, even though maybe you had done a cost segregation in the past. Is it like another segregation study once you're done with the original one?
Yeah, we'll do an updated study on the renovations themselves. So we're going to take, not just pictures, not just see that, but we'll use the actual construction costs, like a construction budget, or more accurately, like an AAA document, which is when you complete it and you have the CFO and you have that kind of stamped document that says these are the costs, these are the things that were spent. That's what we'll use to kind of verify that. Whenever you're dealing with tax in the IRS, you want to make sure everything is documented and everything can be verified, because God forbid, if someone's audited, you want to make sure you have all the records to back it up. So included in our report is, yes, following all of those facts and circumstances, following all the actual, real money.
Definitely. Great to get clarification on that. That was just one of the questions I had. But so can you walk us through maybe an example of a project you guys did recently, and maybe walk through the different components of how, this whole process worked out?
Sure. First and foremost, we always run a free feasibility analysis. So anytime that you have a property that you own or you've owned over the past, right? Because you can do this retroactively, even if you own a property for a number of years, or you have a new acquisition, or you're planning on buying something, you just have something under contract. We'll always take some of those details from you, run an analysis to show you what the potential tax savings could be. And we've done about 18,000 of these. So we know pretty well when we look at some details what the potential could be in the tax savings. So we'll run those numbers. Once you decide that's something, this makes sense, it's a no-brainer. And for most properties, just to interject here, anything over a $500,000 purchase is pretty much a no-brainer. There are even properties smaller than that make sense as well, but anything over that, it's pretty much a no-brainer in terms of the cost and in terms of the the tax savings. Once you do that, we do an on-site engineer visit, which again is part of the principle of this, is the engineer visits someone who's not just trained in construction engineering, but also in the tax code, which describes all these different components, right? There's a lot that's in there. You got to know, like, okay, this shelving versus that shelving, this type of asphalt versus that type of concrete, or the bollards, and everything has a different category or also a reference code. I mean, in the tax code itself, part of the report that we produce, which is really the next step, is extremely detailed and referencing to the tax code every individual kind of line item. And so that's part of the process of in the cost segregation audit techniques guide that the IRS requires to do. So again, they'll take the engineer site visit. We actually transitioned because of COVID over the past year and a half to do a lot of these virtually, which means we'll still have our engineer, but when there was no ability to travel to actual property, we still had hundreds of people saying, well, we got to get this done. How are we going to do it? We started doing them virtually, meaning someone on site can just have a video call with our engineer. They'll record that, walk through the property, and then take that data and produce the report from that as if they were there. If they were there, they would do the same, just take a video or pictures or measurements. And it's as if, so that's really something that is kind of a new feature, if you will, that's kind of helped streamline the process and make it much more accessible. Even though we work in all 50 states and have for the past 16 years, but this has actually helped cut down travel costs and cut down time, et cetera. Once you have that report done, it's going to create a new depreciation schedule. So instead of what your accountant may have done in the past, is taking that purchase price and subtracting something for land, and then that's it. Putting that over a 27.5 year, straight line depreciation schedule. What we're doing is giving an updated schedule with 5-year, 15-year, 27.5, and breaking down that line by line. You have that to go year after year.
That makes sense.
Awesome.
And would you include that schedule? I'm assuming your accountant would utilize that schedule to be able to, fill out. If I sent that report to my accountant, I said, hey, I just did a cost segregation study. You have all my other tax information. here's the report. And then from there, they would probably include, whatever the numbers were within that report, within the schedule to kind of show that the depreciation was taken for these different line items. Is that correct?
Yeah, exactly. Even if an accountant doesn't know anything about real estate, which many don't, by the way. So it's worthwhile to get one that does, especially if you're a real estate investor, because there's so many things, deductions like this that are just laying on the table that an accountant who does not understand real estate or doesn't really know these deductions, know these processes, won't mention to you, just won't be proactive enough. But yes, we do basically all the work and just hand over that report, which has that one page in it, that depreciation schedule. They just take that, literally plug in the numbers. There's really nothing more to do.
That's great. And pro tip, if your accountant isn't specializing in real estate, reconsider, right? So that's great.
Definitely if you're an investor.
Awesome.
So I'm going to kind of shift focus a little bit here. One of the questions that Raphael and I like to ask our guest on the podcast is, what is the most impactful book that you've ever read? It could go back a few years or even yesterday. So however.
The most impactful book I've ever read. I would have to go with, and I've mentioned this in the past, but there's a book called, it was originally a Hebrew book. The majority of my books, I have about 2,000 books at home, and almost all of them are Hebrew or Aramaic, like ancient, Jewish texts. I've read a lot of business books as well, but I'm going to switch directions on this because this book has been definitely the most impactful. It's called The Way of God. So it's really just a book that was written in the early 18th century, right, 1700s, from an Italian scholar, philosopher, rabbi named Moshe Chaim Luzzatto from Italy. Yeah, just incredible book. Just breaks down everything about religious consciousness and observance, and really has totally changed my life.
Were you involved in theology in your previous career as well?
Yeah, I was. I mean, yeah, I guess if you call it that, yeah, sort of theology.
I don't know the particular term. I definitely don't want to,
No, sure. It's absolutely that. I mean, and not just my previous career, my everyday life until now.
Sure, 100%.
It's 100%. It's totally like basically everything that I do, even within real estate and interacting. It's all, I'm walking with God and living, trying to live the word as much as I can.
100%. And you're here. We're here for a purpose. We're here for a reason, and you're living out your purpose. So that's phenomenal. That's great. So one thing I wanted to ask you, first off, thank you so much for stopping by the podcast. We really do appreciate your time. We know you're super busy, and you've got so many things going on. So we do appreciate the time that you took today to be able to share with our listeners about this phenomenal strategy that I think every investor should have in their back pocket. But one thing I wanted to ask you, and this is typically what we do at the end of our podcast, is we like to ask our guests to provide something to the Commercial Real Estate Treasure Chest. It's a repository of resources that we make available to our listeners. And it can really just be like a helpful PDF, if you have pamphlets or whatever. And we just wanted to kind of give you an opportunity to ask what you're willing to contribute today.
Sure. Yeah, I think I'll contribute some case studies on cost seg. So we have on our website actually, and I'll include a link to that, specific case studies that go through every type of property, not every single type of property imaginable, but most types of commercial properties, and what it actually looks like from a breakdown of cost segregation.
Yeah, that's great. Yeah, having visuals is helpful for a lot of people, especially with this type of strategy where there's a lot of moving pieces. So having some sort of visual representation of what we're talking about, I'm sure is going to help a lot of people. So if you guys are listening to this, we'll have it on our website as well. You just access this episode, and you'll be able to download that case study. So,
Yonah, I want to say thank you as well. I know we both appreciate you coming on, spending some time with us, sharing your knowledge. And I definitely, again, commend you for being a teacher and still continue to teach us and everyone out there who's willing to learn. And so if someone's willing to learn more, how can they contact you in the future?
Best way to contact me is through LinkedIn, believe it or not. I mean, that's how Raphael and I got connected, and I'm extremely active there. I actually check that, more than I do my actual email. But you can go to yonahweiss.com as well. I'm very active. A lot of resources there as well.
100%. I'll vouch for the LinkedIn side of things too. He also hosts a commercial real estate LinkedIn challenge. periodically throughout the year. So if you do add him on LinkedIn and start engaging with him, he will be doing these LinkedIn CRE challenges. And I highly encourage you to get involved with them because, you see a bump in engagement on LinkedIn and you get to network with some really impressive individuals across the world, really. So it's definitely great. So if you have an opportunity to tune in, you should definitely do it.
Thank you. Appreciate that.
Of course. Well, Yonah, thank you again so much for stopping by. If you guys are listening to this in a podcast format, Apple Podcasts, Spotify, whatever, feel free to leave us a 5-star review. Really do appreciate it. And leave in the comments, leave some feedback as far as what you guys want to listen to next. If you guys are watching this on YouTube, we'd really appreciate if you can like and subscribe to the channel. It helps with the YouTube algorithm and ensures more and more people can hear this message. So thanks again for stopping by, and we'll see you all next time.